Today what we want to do is finish what we had last class, where I was showing you how to build an efficient frontier when you have two assets. Really want to make sure everybody just fully understands this concept of correlation, how it affects risk, and it really affects risk more than return. I mean, it doesn't really impact return, so it's risk we're talking about. So understanding that conceptually and mathematically, and then we'll turn to these value risk problems using correlation. So in the first exam, we have very basic value risk problems, just making sure you can do the mean minus the number of standard deviations times standard deviation to come up with your VAR. Very straightforward. When we incorporate correlation, just like you saw with your banks, has a huge impact on risk, and it also has a huge impact on uncertainty, because how much can we rely on correlation as a mitigation technique. And so we might today start this conversation about, is diversification really an effective tool for mitigating risks? So we'll first use it, show how wonderful it is, does a great job of managing risk, and then we'll question what we just did and see if it is really that effective. All right, so last class we used this formula right here. The weight of A squared times the standard deviation of A squared, the weight of B squared times this standard deviation squared, plus 2, weight of A, standard deviation of A, weight of B, standard deviation of B, and correlation of A and B. And when we did that, we ran 3 scenarios: standard correlation of 1, correlation of 0, and correlation of -1. So we have perfect positive correlation, perfect negative correlation. You can say perfectly positively correlated, perfectly negative correlated, and you have uncorrelated. And we calculate the risk doing exactly that. The weight squared times the standard deviation squared, weight squared times standard deviation squared, times 2, weight of A, standard deviation of A, weight of B, here B is the stocks, standard deviation of stocks, times the correlation of stocks to bonds. We took the square root of that, and we got our risk numbers. When correlation was 1, we just got a straight line. When correlation is -1, we actually got something that went to 0 risk. When correlation was 0, risk actually declined early and then started coming back up. Our return for each one of these is the same. So the question is, what does correlation do at any level of risk, at any level of return? So at level of return of 5.6, uncorrelated, your risk is 8.8. Perfectly correlated, your risk is 8.8%. Uncorrelated is 6.84%. And negatively correlated is 4%. So you see, at that given level of return, correlation determines your risk. Now that's assuming we know what correlation is. How confident are we that correlation is 1, 0, or -1? That's a big question we'll have on the second exam. So I graph these, and I did the 3 scenarios. Correlation of 1.0, there you just get a straight line. And as risk becomes uncorrelated, correlation of 0, what you notice is at any given level of return, the risk shifts to the left. So the return is the same. Here the return is 4.4%. What changes is the risk level, because we have risk down here. I should have labeled my axis. So risk, and this is the typical for finance. We put risk on the y and return, risk on the x and return on the y. Actuaries actually flip this. So if you're an actual science major, you might actually see risk on the y-axis. But in finance, we put risk down here. And so a correlation of 1, we just get a straight line. As correlation becomes, when risk becomes uncorrelated, the line bows out and shifts to the left. So the returns are the same, nothing changed with the returns. What's happening is risk is shifting to the left. And then if correlation is -1, you actually get a risk level of 0. So from the efficient frontier standpoint, you would definitely not pick this point down here, because here's a point that is a higher return at the same level or even slightly lower risk. So here the efficient frontier actually really starts right here, because you would never do this. If risk is uncorrelated, you would definitely start here and then go up. There's no reason to do this portfolio or this portfolio, because there's a higher returning portfolio at the same level of risk. So this is a graph I would keep in your mind. It's a little tough to build because you have the same, your X is actually your returns. I mean, your X is actually your risk, but you have 3 X's and 1 Y. So it's a little hard to do this as a graph. I had to build it. And if you actually look at the data, each one of these, if you edit it, it has the risk and return is always line 19. See line 19, Y is your return, that's line 19. And so when you do each one of these, you get a different risk line, but your return is the same line all the way down. So it's a little tough to build, but you just build each line, 16 and 19. You notice 19 is always the Y series, and then the risk is the one that changes. And then I made it a line graphs because I like to see the lines, not just the dots. So this is somewhat, you could probably find almost exactly this chart out there on Google Images. You'd probably find something almost identical to this. If you just type efficient frontier graph, this graph might come up there. Now, this is the efficient frontier with 2 assets. What happens when we add more assets? Since that's what you'll be doing on your second project for this class, is you'll be doing, I forget how many assets there's are, 8 or 9, I forget what I added, but when you have multiple assets, the math stays exactly the same, except for you have to do this formula for every single combination. Asset A to asset B, asset A to asset C, asset A to D. Then you have to do B to C, B to D, B to E, then C to D, C to E. So I'll show you how I set that up. With 2 assets, we can do it very easily with a line. With more assets than that, it gets a little bit more complicated because there's different combinations of the assets that are going to be the optimal return. But here I wasn't looking for the optimal return. I only had 2 assets, so I only had 2 choices. If I put anything in A, I couldn't put that in B. When you have 3 assets, then it's not so straightforward. How do you change your allocation between the 3? So it's much easier to understand the efficient frontier with just 2 assets. The graphs look very, very similar whether you use 2 assets, 3 assets, or 4 assets. You'll get very similar depending on the degree of lack of correlation. So your goal is to find things that are uncorrelated, because when you have uncorrelated things, it doesn't affect your return. What it does is it shifts risk to the left. And you saw that with your banks. They had the different combination of things that they did, and then they had that correlation, that diversification effect subtracted out. So essentially you said, here's our risk. Everything's perfectly correlated, but it's not. And so our return doesn't change, but our risk shifts to the left. All right, so that's where we're going with project 2. So let's actually practice this some with some real life scenarios. We'll still be doing only 2 assets to keep it a little simple, and then when we do project 2, we'll be doing many more assets. All right, so this is a problem that you'll see on exam 2. Remember, exam 1 is the basic VAR problems. Exam 2, I bring in correlation. So let's just look at this problem very slowly. We'll do a couple of them. So that may be why I'm going to take my time. I don't want to rush you through this. I want you to let it sink in exactly what we're trying to do. And we're getting very, very real life here. These are problems that I actually had to work on, especially as I was dealing with hedge funds and how I to bring them together. So let's look at it. You're making a recommendation to change a portfolio. It's a $1 billion portfolio. Its current VAR is over 100 million. We'll actually calculate the VAR. This fund has a risk tolerance of 0.3%. How do we get that? Well, it just depends. When I did hedge funds, I had a sense of what my risk tolerance was based on what portfolio I was working with and what I knew about the firm. So that's very subjective, but you want to make sure you have some idea what risk tolerance you're at. Your boss has expressed a desire to reduce VAR below 70 million. All right, so real important in these problems is to figure out what is it that your boss wants to do. So she wants to reduce VAR from 100 million to below 70. So she thinks they're taking too much risk. It might be, maybe she thinks we're going into a period of high risk, high volatility, and she just wants to bring that VAR down. But she doesn't want to destroy expected return. She wants the return to be the same or higher. So right there you have your objective. Your boss wants to reduce VAR, but doesn't want to harm return. All right, so that's got to be part of your answer. Once she says what she's at, and if she said, I just want to reduce VAR below 70 million, and maybe she'd be willing to actually reduce return to do that, then that you say, okay, we'll get lower return, but our return, lower risk, but our return will come down some. That's fine, but that's not what she's saying here. She doesn't want to give up on return. Now you look at that and say, well, wow, we should have been doing that all along. But she's opening up. Maybe you started, I remember at UTSA, we started with 1 or 2 hedge funds just to get the CEO used to it and comfortable with it. And then once they got comfortable, we're like, okay, that opens the world. We can start looking at a lot of other funds. Once we bring those together, we may be able to find much better combinations that really improve our return risk trade-off. So what you're going to do is you got some strategies. You have your current strategy, but you're also looking at strategy A and strategy B. And so what you've decided is we'll put either 10% or 20% in A or B. So we're either going to do 90% current strategy and 10% A, 80% the current strategy and 20% A, 90% the current strategy and 10% B, or 80% the current strategy and 20% B. You notice she's not letting you allocate to both A and B. We'll look at that and see when we build it in Excel which of those might be an even better answers. So you'll have to set this up and do the math. It's not that difficult, especially if we're doing the math in Excel for the final because of COVID. You can definitely set this up and move fast. So your firm uses the concept of parametric VAR. Well, that's good because that makes it much simpler. You've been asked to prepare the following presentation. Which allocation you recommend and why. So you have to put that and why in your answer. She wants a graph. She wants part of the presentation of a graph demonstrating why you're recommending one versus the other. And she wants VAR in percents. So there's different ways you could do it. You could do standard deviation. You could do VAR in dollars. You could do VAR in percents. She wants you to do VAR as a percent. And then she has this last question. We'll come back to this. We're going to compare parametric VAR to stochastic VAR, and we'll look at that and see what answer we get there. So we'll have to learn one last technique. Those in my property and casualty insurance class, insurance finance class, they've already learned how to do the stochastic, but we'll do it in here, and I'll show you real quick how to do that. So here's our data. We have our current strategy has a expected return of 6%. I should say expected standard deviation, but the standard deviation is 6%. And obviously it's correlated 1 to itself. Strategy B, if you do strategy B, your return will not go up because it has an expected return of 6. So whatever you put in A and current, you're going to end up with 6%. But she said maintaining was okay. So A is still okay. A has less risk than the current. So if you add A, you know your risk will come down, but it's positively correlated to the current strategy. B has a higher return. So if you do B, your expected return will increase, but it's a much higher strategy, and it's a strategy that's uncorrelated to the currents. So what does that mean? So we don't get extra return here, but it's much lower risk. We get extra return here, it's higher risk, but it's a diversifying risk. So when we bring all that together, the question is, what is the answer? Right now, it may not be obvious to you which one's the right solution. Once you do a few of these, I think you're going to discover how critically important correlation is to these problems. So let's look at this in Excel and see if we can get our hands around this problem. All right, so I've put this into Excel. The portfolio is $1 billion. So that's given. Let me mark anything that's given as green. the risk tolerance is 0.3%, that's given. So what is 0.3%? So you take 1 minus 0.3%, you're looking for 0.997 in the table. There's 0.997, that's a 2.75 standard deviations. So that's something you have to calculate, like that orange. There is a function. So there is a function, norm.s.inv. If you take that in parentheses 1 minus your risk tolerance, it will tell you the exact number of standard deviations. So I'm using 2.75. The actual number is 2.74778. So we're actually going to use this function in the second project. Let me put that formula over there so you can see it. Let's put the formula over here just in case you want to use it. So we're going to actually use 2.75. We're going to round it, but this function will actually give you that. So you just put that raised to the 1, in parentheses 1 minus your risk tolerance. So it's looking at it the way Goldman Sachs does, the 95% risk tolerance. Our risk budget, she's told you she wants a VAR below 70 million, so that's our budget. Here's all our inputs, so that doesn't change anything, so everything's there. And then so down here we come down with what are our options. So here are the options that she has given you. The current we know is not going to work because its VAR is greater than 100. We'll actually calculate it. We can do strategy A at 10% or 20%, leaving 90 and 80% in the current strategy. We can do B at 10% or 20%, leaving the rest in the current strategy at 90 and 80%. All right, and so our expected return is very, very easy. You just take the weight of the current times the return on current times the weight of the new times the return on the new. And we know if we have A, that is going to give us 6% because A has a return of 6%, the current has a return of 6%. It doesn't matter what we put in A in the current, we're going to get 6%. With B, we'll get a slightly higher return. So right here, we have 90% times 0.06 plus 10% times 0.07, and that gives us 6.1%. Here we have 80% times 0.06 plus 20% times 0.07, and that gives us a 6.2% return. So there the returns, it's just a weighted average of the returns. And then we do risks. So remember on risk, you'll just have to know this formula. If you're looking up this formula, you're in trouble. This is a formula every finance major knows off the top of their head. So the square root of the current weight squared times this standard deviation squared, the weight of the new squared times this standard deviation squared times 2 of the weight of the current times the standard deviation current times the weight of the new, standard deviation of the new, and the correlation of the new and current. And so you look at that in percents, and you see obviously it's 6% with the current. When you add 10% A, we can do that really, really quick. So 0.9 times 0.06. So 0.9 times 0.06. So we're going to square that. So 0.9 times 0.9 times 0.06 times 0.06. And then we have 10% in A, 0.1 times 0.1 times 0.05. Remember, its risk was 0.05 plus 2 times 0.9 times 0.1 times 0.06 times 0.05 times, and the correlation was 0.4. And we take the square root of that, and we get 5.62%. So essentially on the risk, I probably shouldn't mark that one, and that one's just given. But for A and B, we have to actually calculate those. Now that's standard. That's VAR in percents. That's what she wants you to put on the graph. But you also want to calculate VAR in dollars. Well, VAR in dollars is very, very straightforward. All you've got to do is take the portfolio, $1 billion, and remember the VAR in dollars. So this is not VAR, this is actually standard deviation. So I should have said that, standard deviation. So what is the VAR? So the VAR in percents. We should do that VAR in percents. So what is VAR in percent? Remember, you take the expected return minus 2.75 times the standard deviation. So here's, I should have put this in here. So here's, and remember we do it in an absolute value. We don't want negative numbers. So we can do that all the way across in here. I don't know where I messed it up. That 2.75, we got to lock that in. And so there's my VARs in percents. So you'll need to calculate that. Remember here, you just take the mean minus 2.75 times the standard deviation. Very simple formula, so you put that in there. And so what is my VAR in dollars? Well, my VAR in dollars is just going to be my VAR in percent times my portfolio. My portfolio is $1 billion. So 10.5% times $1 billion is 105. Here we have 945, so that's 95, 85, 83, and 67. All right, so those are calculations. So what are you going to recommend? Well, obviously in this case, she wanted to have the same return or higher. Well, all of the strategies meet that. And she wanted risk below 70 million. But only this is the only one that does that. So this is the one you're going to recommend, 20% in B. And so when you look at this, your current strategy is right here. You have a standard deviation of 6%. I didn't do this graph right, so we'll have to change the graph. So let's change the graph. So select data. We want to edit this. So we want our X value to actually be this row right here. Let's see how that does to our graph. And so we'll have to change our axis here. So let's look at it and see. We can probably start this at what, 6%? And so we want to have VAR as a percent down here at the bottom, and we want to have return over here. So which strategy do we do? Well, there's our current strategy. 10.5% value at risk and a 6% return. There's your strategy A. Strategy A definitely helps you reduce risk. But if you think about it, where does she want to be on her value at risk? Well, she would like her value at risk to be 70 million. Well, 70 million equates to 7%. So you might actually insert a line right here at 7%. That shows that's where you want to be. You want to be to the left of that line. And so there's a strategy you'd actually recommend as a higher return, 6.2% return, and it has a risk below her desired 7%. So when you put all that together, you've got a really, really good strategy. Now, what's the actual best strategy here? Now I'm not going to combine A and B. I'm just going to do B because we know B is the better strategy. So let's say we got 20% there, and we want to find something that will give us a return. Let's say our goal is to have a return of at least 6.7%. or even better, let's say we want to have a VAR of exactly 70 million. All right, let's try that. So let's do data solver. So what do we want to do? We want to maximize the return by changing our allocation to B, and we're going to add a constraint that we want this to exactly equal 70. We need one more constraint, but I'll solve it. It's probably not going to like the answer. So well, actually it gave us a pretty good answer there. So if we put 18% in B and 82% there, we get a 7%. We get a 7% value at risk, and we get a return of 6.18. That's not as high here. So this is actually better. So let's try going even lower. So let's shift it, and let's say we want to minimize that by getting a return that is greater than or equal to, let's say, 0.062. Let's see where we can get there. I never know where this is going, but let's just try it. We found the solution. So look at there. If we put 35% in B, we get a very, very low value at risk, and we get a 6.35% return. So why in the world wouldn't you do this? That's a much better answer, isn't it? My word, you have much higher return. Man, you'd be increasing return by 35 basis points. That's pretty impressive. And your risk will drop well below. So why wouldn't you do that? Well, our argument when I was at UTSA is when you're using hedge funds, you're a little bit uncertain about their expected return and risk in correlation. You're getting these numbers from the hedge fund. You have a little bit of leeriness. So maybe the current strategy is 5 hedge funds. And so now you want to add the 6 hedge funds, strategy B. And you might say, you know what, strategy B looks really good. I like the numbers, but it may be too good to be true. So I don't want to put more than 20% in any one hedge fund. And so that might be, you know, it's obviously the math tells you to go 65% your current strategy, which might be 5 hedge funds, and 35% all in this one new hedge fund. But boy, you know, your data is based on certain historical environments, and the next environment might be COVID-19, which might be very different, or it might be the 2008 financial crisis. And you might not have that data in your data yet. Maybe this is 2007 that you're looking at this. Or maybe the next crisis is very different. And so you say, okay, B looks good, looks great. We should put a lot in the B because it's a very diversifying strategy. Maybe it's a managed futures manager, has a very uncorrelated distribution to what you're doing. And so what you want to do is find a strategy that that works, gives you higher return, lower risk, or whatever combination, but also you don't want to bet the farm on it. And so that might be one reason why they don't want to do this strategy. So if we go back to the problem, so the first thing we asked is which allocation would you recommend and why? So we're going to recommend current strategy with 20% in B. And why? The reason you recommend that is you meet her criteria. It's the only strategy that maintains and improves return. Now, all 4 of your options did that, but this one actually improves your return, and it's the only one that gets your VAR below 70 million. Now, you get asked the question, why not 35% in B? And that gets back to, you know, maybe your limits of how much you can put into one strategy. But there's your recommendation. You get a higher expected return and reduce your VAR below 70 million. Now you will show all your work, so you'll have that, everything we just showed, you'd have all your work there. So there's your answer. A graph of showing what you're recommending. And so you could just put that graph right into your answer. You'd have to label them, so I didn't label them here, but you label him. So there's your current strategy. There's 90% current strategy, 10% A. 80% current strategy, 20% A, 90% current strategy, 10% B, 80% current strategy, 20% B, and you'd probably want to put a line in here at the 7th percentile and put it all together. You also want to label it, I didn't do that, that this is expected return and this is your risk, your VAR as a percent. All right, so that's what you'd want to put in there. So just put the graph in there, make sure it's labeled. Don't just put the graph in like there, like that, but make sure you label. So make sure you label your graph when you do it on the exam, but there it is. All right, so there's our first example. We'll get a little more practice with this. The key is understand the problem, see what the givens are, and especially understand what your boss is trying to get you to achieve. What is her goal? What is she looking for? Let's look at this last question. We ask about comparing this to a stochastic model. So manager B says, you know what, my value at risk using parametric VAR like you did above overstates my risk. Now we already love strategy B, so we're already recommending to put money into his fund. But he says, but even that, I'm better than that because my strategy is an option strategy. So my downside risk is not symmetrical. I cut off some of that downside risk. So when you're looking at my worst case scenario with the parametric VAR, it won't be that bad. So I ran a stochastic model to show you the true risk of my portfolio. So let's look at that. So when you do a stochastic model, the VAR will be the simulation that equates to the risk tolerance. In this case, 0.3%. So how do you figure out which of these simulations is his VAR? He ran 10,000 simulations. Here's some of the worst ones. Simulation number 1 might be a gain of 40%, but simulation 10,000 is a loss of 21%. And so which simulation? So the simulation that is the VAR is going to equal, so in this case, how do we do that? If you're in my P&C insurance finance class, we've already done this, but the VAR is going to equal the number of simulations minus our risk tolerance times the number of simulations plus 1. So in this case, they ran 10,000 simulations minus 0.003 times 10,000. That's going to give you 9,970. And then you add 1, and that will give you 9,971. Why not 9,970? Well, the simulation we're interested in is the 30th worst one, right? Because 0.3%, that's 30. It's the 30th worst one. Well, 9,970 is actually the 31st worst one. So we want 9,971. And so that's going to be simulation number 9971. So here, so the VAR, the stochastic VAR at 0.3%, is going to equal 14.7%. Remember, we do it in absolute value terms because VARs are always expressed as positive numbers. Now, when you run your simulation, you get a loss because you're going to take all of your simulations and rank them from the worst one to the best one. The best ones will be big gains, 20-30% gains, but your worst case will be losses. So here the stochastic VAR is 14.7%. So what is their parametric VAR? Well, we've done that a bunch of times now. Hopefully you're getting good at that. So what is that going to be? So remember the formula there that we've used over and over again. It's going to equal the mean minus the number of standard deviations times the standard deviation. That's going to equal, remember here, the expected return is 0.07 minus, we're doing 2.75 standard deviations times 0.09, and when we do that, we'll get our our number, which is going to be, and remember, we take the absolute value of that, and that is going to equal 17.75%. And so what do we say? Well, we say the data supports his point as the stochastic var of 14.7% is much lower than the parametric var of 17.75%, probably because parametric var assumes a normal symmetrical distribution, while the stochastic var can incorporate skewing in the data. So, you know, some answer give a complete, because it says discuss. It doesn't just say does it support or not support it. You can't just say the data supports his case. You got to give me some data. You got to give me some numbers. I definitely need the 14.7 and the 17.75 in your answer. All right, so we'll get a little more practice on this in the next problem, but now we've got an entire problem worked. So let's try another problem. Just give you a little more practice here. Here's the next problem. So in this problem, it's an absolute return fund. So what is an absolute return fund? Well, the goal of an absolute return fund is usually it's stated as maybe T-bills, whatever T-bills are yielding, plus a spread. Maybe T-bills plus 4%, T-bills plus 5%. It's an interesting strategy. It tends to try to be completely uncorrelated with everything else. There's some famous ones out there. Probably the most famous one I can think of is the PIMCO one. So here's PIMCO. It's called Stock Plus Absolute Return Fund. So the Stocks Plus, so it's actually a stock portfolio plus an absolute return fund. So this is what I recommend that you go out and research. It's called alpha beta separation. So the beta is the stock. They're going to give you the S&P 500. That's the beta. They're just going to buy the market. They'll probably use futures to do that. And when you do futures, the futures, you have to put aside some margin, maybe 15% of the portfolio value. That leaves you 85% of cash that you can do whatever you want to with. And so they're going to take that remaining amount of the cash of the portfolio and they're going to create an absolute return fund that they're going to put on top of the stock return, so they hope they can beat the S&P 500. This is PIMCO. I love PIMCO. I always loved working with these people. Boy, I wish we could have some UTSA students go to PIMCO. I don't think we've ever had a UTSA alumni at PIMCO that I know of from finance. There's probably someone in cybersecurity or somewhere. But a really excellent firm, famous firm because Bill Gross was, you know, its CEO for the longest time. He had a great career, although it didn't end on the highest of notes. Definitely a great career. Great people, very collegial, very warm, friendly people, but also very serious and really put their customers first. It's an excellent, excellent firm. So this is their stock portfolio that they add an absolute return on top of it. And the benchmark's going to be the S&P 500. So that's not the absolute return part. The absolute return part is how they try to beat the S&P. It's on top of the S&P. And so when you look at it, you know, it has a pretty high expense ratio, 72 basis points. Here's its returns. What's more important is its returns versus the S&P 500. And they've had a great run. In 2010, they beat the S&P 500 by more than 10%. They kind of tied it in 2011. They beat it by another 10% in 2012. So that 10%, so remember, part of their portfolio is just giving you the S&P 500. And the rest is this absolute return fund. So you can see it added a lot of return. 2013, not so good. They had a bad year there where they underperformed by 1.5%, but it wasn't disaster. Had a kind of matched the return. Then they had a bad year in 2015. But they got all that back the next year. did okay in 2017, had a bad year in 2018, but had a good year in 2019. And 2020, I don't know when they ran these numbers. 2020, they were somewhat matching the index. You can see that they did sell off in 2020, but they were matching the benchmark. So here's the S&P 500, and then their absolute return added that on top of it. So you can see they've done a good job. They have the S&P 500. They have a PE ratio just like the S&P 500. We'll talk about standard deviation, Sharpe, information ratio, and tracking error. Their information ratio is not all that impressive, but we'll talk about that. But everything in their portfolio is going to look just like the S&P 500 except for that absolute return part. And that's probably very fixed income bond looking types of long and short strategies that they're doing because they are a bond company. PIMCO does bonds. And so what they're trying to do is give you the S&P 500, but they're going to beat the S&P 500 not by trying to pick which stocks to buy in the S&P 500. They're going to try to beat the S&P 500 by taking their skills in the bond market and using that to give you the extra return. That's why we call it alpha beta separation. The beta is the S&P 500, but the alpha is freed from the S&P 500, and they can get it to you from any way that they can figure it out. So great strategy. I love it as a concept. We did some alpha beta separation when I was at UTSA, especially in our pension plan. So yeah, it's a wonderful way to try to beat markets. If you have some skill in this particular area, you can add that skill on top of any index, and you know, you can have some return. And that the way you added it was some kind of absolute return strategy. All right, so here's a portfolio that has that kind of strategy. We're trying to figure out what to add to this strategy. So we have this absolute return strategy. We want to add a new fund to it, either strategy A, B, or C. We want to put 20% of that, 20% into that new strategy, leave 80% in where we are. The portfolio is $100 million in size. Your risk tolerance is 0.2%, so that's going to be important. And you want to get the VAR below $7 million without harming expected return. All right, so we look at these strategies, we can already see strategy B is going to be a problem because if you put money in strategy B, your return will come down. You cannot add, correlation will not do anything to improve your return. Your return is always going to be the average of the two strategies. So we already know B is not going to be a good strategy. We'll still look at it and see what it does to risk. Strategy A will greatly improve our return, but it has much higher risk. C will improve our return a little bit, but it has much higher risk, but it's a better diversifier. So you're probably already have an idea which of these strategies will make sense, but we'll see. So which strategy would you recommend and why between A, B, and C? And then why. You got to say the why and then provide the graph. So let's go to the Excel and let's see what we can come up with. So here's the Excel. I gave you the 100 million. I gave you the risk tolerance. I gave you the risk budget. I give you all these returns and risk. Remember, for this number of standard deviations, we find not 0.2 in the table, but 1 minus 0.2, so 0.998. There's 0.998, so that's a 2.88 sigma event. Or you can use the actual formula, norm.s.inv, 1 minus 0.2%. And that also gives you the 2.88, but it's actually 2.8782. So either way is fine. We then come down here to the math. So here's the strategies you've been told to look at. You already know the current strategy has a return of 6% and a risk of 6.5. So what is our strategy A expected return? Well, we have 80% in current strategy, which is a 6% return, and we have 20% in A. A has a return of 0.07. So we combine those two together, we get an expected return of 6.2%. What's our expected risk with A? Well, we'll do 0.8 squared times 0.055 squared, because that's the risk of the current strategy, plus 0.2 squared times the risk, 0.065 of A, plus 2 times 0.8 times 0.2 times 0.055 times 0.065 times our correlation, 0.4. We do all of that and take the square root of it, and we'll get a risk of 5.6%. So what is our VAR? Our VAR is going to be the mean minus 2.88 times our expected risk. So our current value at risk is 9.84%, or with a $100 million portfolio, it's $9.84 million. And we do that all the way across. And so what do we see? Which strategy we like? Again, it comes down to strategy C. Even though it has the highest risk, that lack of correlation really helps us. Has a slightly higher, now A has the highest return, and it's always going to have the highest return. Whatever we do with A will give us the highest return, but C is the only one that gives our risk below $7 million, and that was our goal. And so when we graph all of these, we're going to do our risk here, VAR in dollars, but you know, she didn't say how you want it. She wanted the y-axis, but here I'm going to do VAR in dollars. And so my current strategy has an expected return of 6% and a value at risk of 9.84 million. If I move 20% to A, I get a higher return and lower risk. So A is definitely superior to just doing what we're doing now. But we wanted a risk below 7 million. If we do B, the bad thing with B is it reduces our return, which she didn't want. It does, though, do a good job of reducing our risk, but it's not obviously superior to the current. While it has much lower risk, it also has a lower return. So then we look at C. C is not necessarily superior to A, has a lower return, has a lower risk. So it's, you know, we don't know if A or C is better, but given her desire to get the risk below $7 million, C is the obvious strategy to do. Now let's look at C again, like we did last time, looking at, you know, what could be the best strategy. So if we do 1 minus C's, and we say we want 100% in the 2, so let's try a strategy. Let's do data solver. Let's maximize our return by having, let's add a constraint that makes our risk exactly equal to $7 million. And we want to make sure, so we'll add a constraint that we want the sum of those two allocations to equal exactly 100%. I never know if this will work, but let's try it. And here you can see, if we put 19% in B and 81% in C, we'll get exactly that. But that's almost exact same return as we have here, with slightly higher risk. So the 20% is slightly better, even though the returns, the rounded returns are the same. The risk is slightly lower. We could try one where we say, let's minimize the risk. So let's minimize that by changing again our allocation. And how will we do that? Here we want to change this. We want our return to be greater than or equal to 6%. We say OK. I don't know if this will work. We'll try it. Hit solver. Say OK. And then you can see, wow, let's allocate 38% to C. If we do that, we'll have a higher return and much lower risk. Boy, you can't, that's much better than what we're recommending. But again, why don't we recommend 38% for C? Well, because we may not want more than 20% in any given strategy. All right, so then again, you do your graph. We'll copy our graph and bring it over to our answer. So there's our graph. You'd have to label it. You'd want to put that 7 in there, label that the x-axis is return, expected return, the y-axis is value at risk in dollars, or however you're going to do it. She didn't really say how she wanted you to graph it. But you have to graph that this is the current, that's 20% current A, and 80% current, 80% current, 20% B, 80% current, 20% C. And why do you recommend? So you recommend 80% current, and 20% in C, as you get a higher expected return. No, that's not how you spell the word higher. Get a higher expected return, and the VAR is below 7 million. So that's the best. A gives you the higher expected return, but doesn't get the VAR below 7 million. B neither gets you VAR below 7 million, and it also hurts your return, so that doesn't make sense. So give what you're recommending and why. Put your graph in there. Make sure you label the graph. I didn't do that just to save time. All right, so now we got another solution. So now we want to look at this last part of this problem. And so we'll ask the question here, do we have any concerns about parametric versus stochastic? And so here we ran a simulation just of the current strategy. So here we're only looking at the current strategy. We don't know about A, B, and C. And so our current strategy has the parametric VAR at 0.2% of the current strategy equals, so remember how we do parametric VAR. So we know that the mean, it's going to be the mean minus 2.88 times our standard deviation, because we're looking at a 2.88 event. So our mean in this case is 0.06 minus 2.88 times 0.055, and we'll do it again, the absolute value of that. And so you have to calculate that, then we'll convert it into dollars, because you're going to see that the stochastic model is in dollars, so we have to convert it. So if you take 0.06 minus 2.88 times 0.055, you'll get what we already knew. We saw that up above. We get 9.84%, or $9.84 million. So what is our stochastic VAR? At 0.2% of the current strategy. Well, the first thing we have to do is figure out which simulation are we looking at. So 0.2%. So we take, how many simulations we run? 10,000 again. That makes it nice. 10,000 minus 0.002 times 10,000. Well, that's 20. So that's going to give us 9980 plus 1. It's going to be simulation 9981. There it is right there, simulation 9981. So that equals 10,970,000, or 10.97 million. And so what can you say is we notice that the stochastic VAR is much higher. Stochastic VAR, which is 10.97 million, is much higher than the parametric VAR of 9.84 million, suggesting some negative skewing in the distribution of the current strategy, which parametric VAR misses, as it assumes a normal distribution that is symmetrical. And I know I've got typos all the way in there. I can't type and talk at the same time. Distribution is a word I can't spell, but there's your answer there, and you have all of that in your answer. So we've been through two problems now. We'll get practice in one of our live streams where I'll do another problem from a previous exam. So we'll get more practice with this. They all start looking very similar because there's a limit to how much I can do. I will say, given that our final, you'll have ability to do Excel, I might do something a little more complex and give you a little challenge, maybe a little extra credit, or maybe one problem that only counts 5% of the exam, but is a little bit challenging to see if you can go beyond this. So we'll see what we can do with this analysis. But there you have two problems, two practices to see what I mean by using correlation to help you give a more sophisticated answer.